The market fails to sustain opening gains as the Nifty consolidates with a 0.3% decline. Financials and IT stocks under pressure, while defense and capital market plays fare better. The mid-cap index is in focus.
A CNBC-TV18 exclusive AGR relief unlikely for Voda Idea, even as the management claims in the company's earnings call that the government has flexibility to intervene. In a recent press interview, Telecom Minister Scindia had said that there is nothing on the table at this point, as the Supreme Court has already ruled on the matter.
Block deal buzz. 4 large trades take place so far on Tuesday. Ola Electric sees a 3.2% equity change hands, while PE investors believed to be sellers in a block comprising of 3% of Yes Bank's equity. Aptus Value and Zinca Logistics also see large blocks with 9 to 14% of equity being transacted.
U.S. Commerce Secretary Howard Lutnick says he's very optimistic about prospects of a trade deal between the United States and India. Says he expects the deal to be done in the near future.
Oil prices gained 3% overnight as OPEC Plus members agreed to increase output at a measured pace. Canada wildfires hit 7% of overall country production. Also, Iran seems set to reject a U.S. nuclear deal proposal, led to premium prices.
You're watching us here on Halftime Report. Good afternoon. I'm Manglam Malu. With me, Ekta Batra. We come to you live from the CNBC-TV18 Motilal Oswal studio. Today, where we're seeing some dips in the market. Remember, at one point, the Nifty was down about 100 points. At one point, it was up around 100 points. And then there was a fair amount of volatility. And now, as we speak, it's the Nifty Bank which is actually taking the frontline index lower. Yesterday, it was the Nifty Bank which supported it at the lower level. But today, it's the one which is underperforming as against the others. The important part, however, is that the broader markets continue to outperform in a manner that they're not falling as much for the mid-cap index. And there still are more numbers of stocks which are advancing than the number of stocks which are declining, even though that gap is narrowing. So the red and green lines come up for you. Hi, Ekta. It's a day of consolidation, a little more choppy than what it was in the last few trading sessions.
Hi, Manglam. Yes, absolutely. I think it was definitely choppier. It's recovered a tad bit from the day's low for the Nifty. So you can see that on an intraday chart. It was down around 0.5% for the Nifty as well as for the Sensex. The Bank Nifty, which did hit a record high on an intraday basis or right at the start of trade, is also under pressure. So down around 0.3% currently for the Bank Nifty. Just want to point out that maybe Monday's low of around 24,524 would become an important point to watch out for the Nifty. In terms of stocks, lots buzzing around when it comes to high volume and price action. So a couple of them include Voda Idea on the back of news, Yes Bank on the back of that equity change, and Eternal, all of these stocks which are making news on the back of volumes as well as price action. But the other stock which is in focus right now is Sun Pharma on the back of a possible inspection of Halol, one of their key plants. It's under the regulatory lens because of a warning letter that they've received. Vivek has more details of this inspection. He's here with more.
Well, that's right. First of all, it's a very important monitorable as far as Sun Pharma itself is concerned. What we are picking up from our sources is that today, 3 inspectors have gone ahead and done an unannounced surprise inspection as far as the company's key Halol facility is concerned. We understand that even as we speak, the inspection is underway. Now, why is this important for Sun Pharma? Remember, for almost over 2 years, Sun Pharma's Halol facility has actually been under the import alert as far as the US FDA is concerned. The facility was inspected in May 2022. Post the observations, there was a warning letter post which the status currently is that of an import alert. Now, at the end of Q4 FY25, when the company hosted the conference call, analysts did ask for an update as far as Halol was concerned, and this is what the company had to say. The company said that, the remediation efforts as far as Halol from the company's end are over, and in fact, they had requested the US FDA to come and visit the site. In fact, they had also guided the street that this is most likely going to be an unannounced and surprise inspection, and they would not know of the inspection in advance. Now, talking about the Halol facility itself, looking at what exactly is the contribution of the Halol facility. Remember, at the end of FY 2022, there was a significant decline of the contribution of Halol given the regulatory scanner. It was under just around 3% of the total consolidated revenue, but a key facility nevertheless. One of the largest facilities, and it is the source of multiple dosage forms such as injectables, ophthalmics, nasal sprays, as well as hormones as far as Sun Pharma is concerned. Now, talking about Sun Pharma's compliance status, right now it's a patchy record that the company currently is as far as the US FDA has regulatory issues at Halol, at Dadra as well as Mohali. Remember, the Dadra facility received an OAI status in April 2024, followed by a warning letter in June 2024. We reached out to the management of Sun Pharma to give us an update and to give us a response to the story that we intended to run. The company said that as a policy, we do not comment on the schedule of regulatory inspections. But this is a key event nevertheless and an important event to track as far as Sun Pharma is concerned.
Okay, all right. Well, thanks very much for that, Vivek. Just, wanted to point out to that particular story, Mangalam, that there are three very tough inspectors who are expected to be inspecting the Halol facility. That's a separate thing. But additionally, the surprise inspections that we're going to see is now going to become a norm. We're not going to be, there's not going to be any kind of prior information that there is going to be an inspection at your facility. This is something that the Trump administration made very clear via the US FDA. And we already saw that with Alembic, which received, I think, 4 observations on one of their facilities. It was a surprise inspection. And for Halol, and we're going to see lots more.
So that it is a surprise inspection won't be a surprise anymore.
It won't. It's a norm now.
All right, let's take that forward with another conversation that we've lined up for you today. We have the partner and head of South Asia at Quadria Capital joining in, Sunil Thakur, and he obviously joins us for our special fundraise segment. This after the company has gone ahead and closed a fundraise of nearly $1.07 billion. Thanks a lot, Sunil, for joining in. What is driving this strong demand in a tough fundraising environment, and what are the themes that you're looking to bet on through this?
First of all, thank you, Mangalam and Ekta, for having me on this show. As you rightly mentioned, we're just coming off a successful fundraise where we raised upwards of $1 billion, 20% higher than what we were targeting. Wasn't easy, especially the challenging environment that we are in, where the global fundraise environment overall is going through some tough times. In fact, it's down by some 70 to 80%. So global funds are down by global fund in terms of fund closes are down by some 70%, and Asian fund closures have gone down by some 80%, over 80%. We've been successful. More importantly, the reason being is our track record and the strategy that we follow, and the strategy of identifying the right segments within healthcare, as we are a healthcare-focused fund, primarily focusing on few large markets in Asia, predominantly India and Southeast Asia. So our ability to find niches, our ability to find the right geographies to invest, and the execution strategy is, I guess, what has made us successfully. And that has been well demonstrated by the track record that we have, which has been appreciated by investors who've come behind us to support us in our investment activities.
Okay. Sunil, I just wanted to, and firstly, welcome to the show. This is Ekta. Just wanted to ask you to elaborate on this tough fundraising environment where you said, the fund closures, for example, in Asia are down by around 80-odd%. Since when are you seeing this trend? What are the key reasons for it? Is it because of this, because of the trade negotiations and the uncertainty around that? Is it more? And what can we expect in terms of a trend?
So, a couple of reasons. So, in terms of since when are we seeing these challenging fundraising environment? It's been over 3 years now. And if I just share some statistics, since 2021, which was the peak time of fundraising, as I mentioned, global funds, their closures have gone down by some 70%. Funds which are focusing on Asia, their closures have gone down by some 83%, over 83%. The primary reason has been a lack of good exits globally, which was most importantly affected by the interest rate that we saw over the course of last many quarters. And therefore, the ability for people to churn capital back into this asset class was a bit limited. The second trend that we saw was the mega funds were getting larger allocations. So there was this concentration of capital. So the big funds, which we were raising $15 billion, $20 billion. So, the entire alternate allocation was getting anchored around those mega funds. And therefore, mid-market funds, which were in the zone of $1 to $2 billion, they were impacted quite a bit. And third, because of this lack of dry powder from the asset itself, we were seeing some structural shifts in how alternate investments were being allocated to different strategies, like secondary buyouts and all of those other products. And that all impacted funds like who were playing in the target zone like ours.
Sure. Sunil, just wanted to now focus on the fund that you all have closed. It's the third fund that you all have closed. Just give us a sense. You're deploying around $700 to $750 million in India. What are you targeting? How much of it is already deployed? Where have you deployed it?
So roughly over 1/3 is already deployed, and this is across the regions that we are investing in. We are obviously looking at a few specific trends and themes that we believe are going to be the winners for the next few years. And some of them that I can share are, models like localization, make in country for the country, outsourcing. There is a big shift happening to some of these strong supply bases like India, Vietnam, and few other geographies in Asia, especially given the geopolitical situation and regulatory environment that is coming about. People want to diversify their supply bases. So India is obviously gaining quite a bit from that. The third is consumer healthcare. Fourth is enterprise digital healthcare models. And fifth is, the consolidation plays. So these are 5 themes that we're going after. If I have to share some specific segments that we like to invest behind, single specialty is something that we are very, very keen on. And we believe the next decade is going to be of single specialty pharma, diagnostics, enterprise digital healthcare models. These are few models that we believe are going to find traction, and we will go behind these models to invest money in.
That's interesting. You preempted my question with regards to single specialty versus multi-specialty, and you've said that you focus on single specialty right now. But, just for the viewers' benefit, what is the kind of IRR or value creation benchmarks that you have before deploying money into any of the companies that you are backing? That's point number one. Secondly, everyone's talking about semaglutide. Do you think there is value to be created there? And the third part is the CDMO API story. How are you looking to participate in that?
So single specialty, yes, we believe that is going to be a winner in the next few years. As far as semaglutide is concerned, there are various models that will come about, but maybe a bit early. But some green shoots that we are seeing are on the manufacturing capacity side, where we are building up capacity for the demand that we see once we have many products or generics being launched next year and beyond. But one model that we are specifically keeping an eye on is on the digital healthcare model, because as you know, the success of these medicines doesn't only depend on taking those medicines, but how do you sort of layer it with assistive care, behavioral change models. So we believe if it's packaged with the right digital healthcare model and support system, you will find clinical success. And we have some examples in India. There are companies like Beto and all that are working with few companies to sort of bring about that model in the market. As far as the question around CDMO API is concerned, we believe there is a great opportunity, especially in the CDMO space, given that we are seeing geographical diversification. Especially the China plus one model in some ways is playing out on the CDMO side, and we've made some investment in that area, and we see that those models to be big winners in the coming few years.
Okay, just before we let you go, Sunil, just wanted you to touch upon 3 of your investments: Aragen Life Sciences, Nephroplus, and Maxi Vision. How much have you all deployed in these 3 companies? How much do you all own? And when do they probably, IPO? What are you expecting in terms of return? And by when?
So hopefully we are expecting good returns. And sorry, Mangalam, I couldn't answer the question, although it's a tricky one, but we try and solve for an organic growth of at least 25%. That should be the minimum return that we would expect from companies that we invest in. And that is what we are hoping for to solve in these the 3 companies. But Ekta, to answer your question, we've deployed about 1/3 of the fund or allocation to India in these 3 companies. All of them are recent investments, and therefore we do have some time before they hit the market, or we look to do an exit from these 3 companies.
All right, 25% IRR is what you're targeting, and that's what you're expecting from all of them as well. 40% of your fund already deployed. Thank you so much, Sunil, for joining in. Wish you good luck with the remainder of your deployments, and hopefully that turns out to be a good investment in terms of wealth creation, but more importantly, impact as well in the healthcare space. Take a short break, come back. We have Sumit Kariwala, who's the India Banks analyst, joins us from Morgan Stanley. Stay tuned. Welcome back. Let's focus on the banking space. This morning, the Nifty bank hit a fresh record high, but today we have, an analyst coming in from Morgan Stanley, and they believe that the tail risks for banking sector have actually decreased. An improving liquidity and easing regulatory environment are the big positives. So how do you bet on the banks, and what banks, more importantly, you bet on? Sumit Kariwala, the India Banks analyst at Morgan Stanley, joins in. This obviously from the sidelines of the Morgan Stanley Annual India Investment Forum, which is currently underway. Sumit, thank you so much for joining in. That really is the first question. We're close to near all-time highs for the Nifty bank. What should one look at in terms of incremental gains coming in from the space, and what would you bet on? More the private sector, large public sector, or the ones which have not moved at all in an otherwise, fairly uptrending banking space?
Yeah, hi. Thanks for having me on this show. So with respect to the sector, it has done well, and that is after a couple of years of underperformance. So it's a welcome positive. I think with respect to the sector, next 2 quarters will be tough on earnings. We see more downward revision to earnings. But I think so the outlook from a second half of fiscal 26 and fiscal 27 is getting more and more positive. There are 3 aspects to growth that I would look at. One is demand. And if I look at the income tax rate cut in the budget, the interest rate cuts that the RBI has done, and they're going to do more, that'll imply that demand is much better going forward. The second aspect is competitive intensity, and I think so this is less appreciated. The incremental spreads of lending in a number of segments, say, for example, mortgages, is very low. And a lot of private sector banks have slowed down growth in these segments because they don't find business to be quite attractive. Now, that's the second important driver. If in second half the spreads improve and the competitive intensity normalizes, that'll also support growth. The third is external factors, anybody's call. And once you have more clarity on that, the earnings outlook will improve that much. Margins will be weak. Next 2 quarters will be tough. There's some bit of lead lag, but the net impact of falling rate cycle is negative on margins. So next 2 quarters will be tough. Second half fiscal 26, fiscal 27 look quite good. You asked me on my framework with respect to identifying stocks, and I would want to spend some time on this. Over the last year, we've been articulating that this cycle is all about profitability. If you look at 2010 to 20, the stocks which did well had asset quality on their side. So if you don't have an asset quality problem, the system was going through this. You had a clean slate. You could gain market share, outperform, and do well. This cycle, I don't see asset quality challenges. I don't see large banks to have competed on underwriting. They've competed on pricing. So any bank over the next 2-3 years which can deliver on profitability is going to not only do well on earnings, but also re-rate even from here.
Okay. Sumita, I wanted your opinion on the 2 segments clearly, the large size banks, the front-facing banks, as well as the mid-size banks when it comes to key metrics, as well as, say, the valuation gap between the 2.
Yeah, so we've been articulating that the large private banks will continue to outperform in terms of valuations. This cycle is very different, as I said, in terms of profitability. What has happened over the last 4-5 years? Let's take a step back. There is a lot of competition in secured lending. The spreads have come down. Liquidity is a very different challenge now. Historically, if you raised 100 rupees of deposits, you had to provide for CRR, SLR, and you were done. Now you need to provide, maintain liquidity based on the category of deposits. A retail deposit will have lower liquidity requirement and so on. This basically changes the construct of managing liquidity on the balance sheet. There have been a lot of changes by the regulators, which has capped fee income in certain segments. So overall, if I look at like-to-like margins, they've come down. In that backdrop, there are 2 or 3 things which can help banks outperform. One, improvement in loan mix. Second, operating leverage. And third, potential to improve liability cost. If I look at across the sector, large private banks are much better placed to do this. And therefore, we think they'll continue to re-rate and outperform the mid-sized private banks.
You know, basis the list of stocks that you've put out in terms of recommendations, etc., the one that stands out is IndusInd, where you have an equal weight, and the other one is Yes Bank, where you have an underweight. I'm asking you this specifically because of the problems that have taken place in IndusInd. At what point do you revisit your thesis here, and where does that stand at right now?
Yeah, so I don't want to comment about individual stocks, but what I would say is that when I look at the mid-sized private bank sector as a whole, we want to be very selective. A lot of profit pools, be it with respect to MFI, credit cards, they have seen a structural decline in profitability. And that is something which is required to make money if you don't have a liability franchise, which is as good as large private banks. So we've been very selective in this space. We have very few overweights, and we think until unless the structural profitability in certain segments kind of improves more than expected, the large private banks will remain our favorites.
Okay. Well, you know, Sumit, the news for today is this entire Vodafone Idea issue. What is your reading of it? Have the banks, the exposure to banks, I think is around 2,300 odd crores. Have the banks fully provided for it? Is there any kind of issue that you would probably see in that? And secondly, you know, the experts who we've spoken to have said that it's a risk when it comes to the entire industry that you're talking about. It's not only Vodafone Idea. From that perspective, what's your call?
Yeah, so I don't want to, again, comment on an individual entity, but what I would say is if you look at the asset quality problem today in the corporate segment, it's negligible. So even if you have some accounts slipping here and there, it's going to be very manageable from a banking sector perspective. In fact, 50% of the banking system is currently working at negative credit costs because the recoveries from old NPLs are so high. So again, I don't think so asset quality is a challenge in this cycle. Will there be some impact on asset quality because of external factors? Possible. We'll have to see how the entire tariff situation plays out. But the point that I would want to make over there is that the balance sheets are quite healthy, be it the corporate segment, SME segment. We've come out of a long drawn NPL cycle. And over the last 3-4 years, there's no significant re-leveraging of, say, corporate or mid-corporate or SME balance sheets. So they are capable of managing the situation unless it's very different than what we would assume right now.
Right. You know, I just had a two-part question, Sumit. So on the one side, there is no real NPA situation that is happening in the very near future. You assign very, very low risk probability to something like that. If that were to happen, where would you see any sort of stress emerging? Would it be retail at current levels or not? Because typically it has been seen as one of the safer sides to bet on. That's point number one. But secondly, while NPA or asset quality risks are declining, there has not been a big loan cycle which has come up as well. When do you expect that to turn?
Yeah, so when you look at overall loan growth, it has been largely, say, 1.2, 1.3 times nominal GDP over the last 2-3 years. But there are segments which have grown very aggressively. Look at unsecured, credit cards, personal loans. They've grown much faster. They've grown 2-3x faster than the overall loan growth. And you've seen some stress come out in those segments. It's not very material in the overall scheme of things because, as I said earlier, the large banks didn't compete on underwriting, they competed on pricing. So you did see some skeletons come out. The same would be applicable in the MSME segment. This segment has grown very aggressively. both by the private banks and the state-owned banks. And if the situation really deteriorates, this is the portfolio that I'll be watchful. Having said that, I'll make one more point on the MSME segment. In my view, MSME of this decade is like retail of last decade. If you look at credit multiplier or loan growth over the last decade, it was not, it was like say 9-10%. Still retail grew at say 17-18%. The same is applicable for MSME. The segment is going to do quite well even if GDP growth is muted. There's a lot of underpenetration. There's a lot of formalization. So I would not worry about that. But yeah, if you will tell me, okay, tell me one segment which we would be watchful, it's MSME.
Okay. Just a quick last question then, Sumit, and just a brief answer. So on top of the list for you would be the large cap banks?
Yeah, large private is where we are excited about.
And following that?
So following that, we've been very selective. So there are certain banks that we like in the mid-sized private banking space. There's a relative outperformance that we expect within state-owned banks.
Sure.
But all of those are tactical ideas. When I think about the next 2-3 years, I think the dispersion with respect to earnings and therefore valuations between large private banks versus the rest of the sector is going to surprise people.
All right, Sumit, we're going to leave it on that note. It's been a pleasure. Thanks very much for joining in and speaking with us. So that's the view coming in from Morgan Stanley on the entire banking and financial space. As of now, we need to take a break with the news, in fact, that we're seeing further profit booking seep into the market. So we have the Bank Nifty, which is now down around 0.4%, and the Nifty, which is down around 100 odd points, along with the Sensex, which has lost around 0.5% as well. We'll take a short break, but up next, we'll in fact full tilt on the market. We have Sachitanan Uttikar joining in to talk about the technicals.
It's a 100-point decline that we're seeing on the Nifty. In fact, ever since we started having our conversation with, Sumit, and we started the show, the mid-cap index actually moved more in favor of decliners than the number of stocks which are advancing. So that's reflected in the kind of advanced decline lines that you should see where they've crisscrossed. It's a Nifty bank which is lower by almost 230 points. And there you have it, intersection on the frontline indices and the broader market as well. It's becoming more of a call writers market than a put writers market, and that's reflected in the decline that we're seeing in the put call ratio as well. The PCR has moved to 0.73. So at some point there will be a revival of that and there will be a rebound in the market. But at what point we need to monitor very closely. Why? Because on the way up, 24,800 call is seeing some writing. So 24,950 thereabouts, there is supply. 24,700 call also is continued to see some writing. So as we move towards that 24,900, 24,850 to 24,900 mark, we could see some supply emanate at the lower level. Though put writers aren't very active, the far and few in between we have. One is 24,600, which has a premium of 170 rupees. Again, opening the room all the way up to 24,400 to 24,450 on the Nifty. The Nifty broke below the 20-day moving average in today's trading session. Let's see whether it can reconquer that at close or in the next couple of days. Though individual stocks are seeing a lot of long positions being added. Federal Bank, Hindustan Zinc and Mazagon Dock are the ones that stand out in terms of open interest being built up on the long side. Though we are seeing consolidation right now, it's a little more on the way down than what it was, say, a couple of days ago.
Okay, all right. Thanks very much for that, Mangalam. Well, we have Sachitanan Uttikar joining in from Trade Bulls to tell us what he's tracking when it comes to the technicals. Sachitanan, welcome to the show. If you could just start by giving us a sense in terms of the Nifty, which is now seeing more of a downtake than maybe a couple of hours ago.
Good afternoon, Ekta. Good afternoon, Mangalam. Clearly, last week as well, we talked about a specific range on the lower side. 24,600 looks like a good demand zone. But on the higher side, we have seen consistent, selling pressure at 24,800, 830 kind of a level. So I think the market is still oscillating within this particular range itself. On a closing basis, it is managing to sustain above that 24,600 mark. Even yesterday, we saw a bullish hammer kind of formation reinstating the overall strength in the major range. So I think it's a good, consolidation wherein some stock-specific action is already very well in progress. But it is the Nifty IT which is dragging the index, and it has some support close to around 26,000, 400, 500 kind of a zone. So probably we may see the Nifty, getting affected because of this. We may see a further decline in the index. But I think this level close to 24,580 would again give a good opportunity to create some long positions. From a trading standpoint, one can keep a stop loss at 24,540 on a closing basis and expect a rebound back towards 24,830.
All right. And individual stocks, what would you be betting on, Sachi?
Mangalam, both the stocks are on the long side. What we have observed is that the real estate pack is doing well. There is a good, strong outperformance throughout the sector. And if you look at the setup of Godrej Properties, now disclosure would be that we have recommended this particular trade setup to our clients as well. After a 4-week consolidation, we have seen a breakout from a triangular formation. The pattern is indicating a price target somewhere close to around 2440. What we're expecting is that there could be a good continuation of this momentum. Hence, we are expecting a move towards 2440, which can be chased with a stop loss at 2270 on a closing basis. So we are recommending building further long positions in Godrej Properties. The other stock on our radar is Bharat Forge. Now, if you look at the overall setup, it has managed to sustain above its 200 weekly exponential moving average support, which is placed somewhere close to around 1240. The long additions are being very consistent. And if you look at the overall price structure, it looks like a bullish flag formation, which is again a good sign of continuation of trend. We are expecting this rally to continue towards 1330 initially. The pattern target is placed at 1380. And hence, we are still recommending building fresh long positions, keeping a stop loss at 1260 on a closing basis.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in. We'll take a break, but come back with more stocks. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, it's been a year to the third term of the Modi-led BJP government. How have the markets performed over the last 12 months? Hormuz is here with more.
On the same day last year, Dalal Street witnessed one of the two most manic days of 2024. Now, exit polls were predicting a thumping majority for the incumbent Narendra Modi government for the third straight term. Now, in response, here's a look at the way the markets rallied on the 3rd of June last year. The Nifty Bank, the broader markets, all of them. But the actual gains came from the PSU stocks, the stars of 2023, carrying on their shine into 2024 as well. Alas, the next day, when the actual results were out, the BJP fell short of that magic 272 number, and the markets did not like that. The market lost double of what it had gained on the 3rd of June. And if the PSU stocks led the up move, they also bore the biggest brunt of the exit polls going wrong. PSUs were the biggest contributors to the 31 lakh crore rupees of investor wealth that was wiped out on the 4th of June. However, when the markets realized that the NDA will remain in power and Narendra Modi will become Prime Minister for a historic third term, the recovery began. The Nifty went on to make a new high 3 months later, as did the broader markets during the course of the year. And despite the sharp sell-off witnessed from then until March of this year, most of these indices have had double-digit gains during the last 365 days. The underperformers, PSUs. And this 4.5% surge that you see is also courtesy of the recent up move that you have seen in these railways and the defense names that has propelled the index back into the positive territory. So who's been the biggest gainer on the Nifty during the last 1 year? The index heavyweights? Not really. Mostly new entrants like BEL, Shriram Finance, Eternal. They are the ones that form the list, completed by legacy names like HDFC Life and Bharti Airtel. The names on the downside, though, should not surprise you other than Tata Motors, the only Nifty stock that had double doubled in value in 2023, is down 20% during this period. And this is after recovering from its 52-week lows. Now, IndusInd Bank and others like Adani Enterprises complete the list. Now, let's take a look at the broader market gainers. Paytm shares are still down 56% from their IPO price. But if you were a buyer in the stock on the 4th of June last year, you would have made a cool 2.5x on your investment already. The recent rally in shares of BSC, Masgaon Dock and Solar Industries also puts them into this club. Now, on the flip side, Vodafone Idea leads the list of losers, followed by Ola Electric, which listed in July of last year. Hindustan Zinc and Astral are some of the other underperformers, down between 25 to 30%. Now, if Masgaon Dock was part of the mid-cap winners, Garden Reach is part of the small-cap winners, also having doubled from June of last year. And this is despite the 60% correction from the top and a subsequent recovery after that. PG Electroplast and Zen Technologies are also part of this list, having doubled and even tripled in value during the last 365 days. Losers here are also not from a specific sector. Birlasoft, which has been under pressure recently after a downgrade, Titagarh Rail, Tejas Networks have all faced some of the other headwinds during the last 12 months, and it shows up in the price. PSU stocks, known for their triple-digit returns in recent times, have barely managed to cross double digits during the last year. Barring BEL, most of the other names in the list have only gained between 10 to 20%, and this I'm talking about the PSE index and their constituents. Even on the losers, the once high-flying names like IRFC and REC are continuing to grind lower, having corrected between 40 to 50% from their highs. So it's been a year to Modi 3.0, and while the markets have delivered decent returns despite multiple global headwinds like tariffs, the PSUs would want to now raise their hand and play catch-up and bring back the days of 2023 when they were simply unstoppable.
Take that point, Hormaz. Thank you so much for that comprehensive roundup of all things that took place over the last 12 months. Take a short break, come back on the other side. We tell you more on Halftime Report.
Well, 24,629 is where the Nifty's at, down around 87 odd points. It's choppy, but in a tight range, you'd have to say. The Sensex has also recovered from that 400-point odd cut that it was showing. It's down around 333 odd points at this point in time. Just watch out for a couple of stocks such as Orchid Pharma, which was a real rank underperformer this year, is showing some amount of traction on the top. So that stock is up around 4 odd percent, but in context is down around 61 odd percent this year. Similarly, even say something like an Ola Electric, which has been in focus, that stock is down around 7 odd percent at this point in time, lost around 42% year to date. But let's focus on some important opinion. Volatility in India is very low compared to other large Asian markets. These are the words coming in from Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley. He adds that they are bullish on India. Listen in to excerpts from that conversation.
Well, we're very bullish on India. It's our largest overweight. And if you just look at the most recent quarter, 7.4% GDP growth, I mean, that is far and away the strongest of the major economies in the world. Volatility on the Indian equity market is much reduced now, which again affects the risk premium as foreigners would see it. It's trading less than half the volatility, for example, of a major Asian index like the Hang Seng Index, when you look at, let's say, Sensex or the Nifty. Important is narrowing of growth differentials in our forecasts versus the rest of the world. As I mentioned, we have India growing easily 6.5% or so. US growth is going to fall, we think, next year to around about 0.5. And at some point next year, not this year, next year, the Federal Reserve will cut interest rates. So we have a sort of a decline in growth differentials. We don't, for example, have European growth changing very much over the forecast horizon. The weight in the EM index is constantly rising. It's the second largest market in the index now. And so what we're seeing is like passive allocations are building towards India, but also for the first time, non-EM dedicated investors who tend to maybe have more of a growth style bias are starting to get involved in India. I think the last sort of 18 to 24 months, it's starting to change, absolutely.
All right, with that, what we'll do is take another short break. And on the other side of this break, we have a special guest. Manisha Gupta joins in with Bala Sarda, who's the founder and CEO of Vadham India. Stay tuned for that.
Welcome back, and joining us on the show now is Bala Sarda from Vahadam Tea. Bala, hi, good to have you on the show. And, there's so many numbers to talk about. To begin with, last year was a great one because India is now the second largest exporter of tea. 10% of global exports numbers come in from India now. And when you look at the categories as well, they seem to be doing quite well. Specialty tea, wellness, and that's exactly why we're talking to you, because you have a stronger name when it comes to wellness teas. 97% of your tea is exported. How have those markets been for you? How have the last couple of quarters been for you?
Thanks, Manisha, for having me. You're absolutely right. I think the market for tea outside of India has been showing strong performance over the last few quarters. I think post-COVID, when it had peaked, it did see a kind of a slowdown over the next 2 years, primarily because of the disproportionate growth it had seen in that 1 year. So it was calibrating to the right numbers. And I think now we are back on track to stronger growth even in international markets versus, of course, very, very reduced growth in India in the domestic market, primarily due to inflation and consumption behavior. And I think the growth, Manisha, you're right, has been driven by more premium products, driven by wellness, driven by teas blended with superfoods, herbs, botanicals, which is what consumers are now looking for. That's what has been driving the market. And I think you see that across numbers. We also saw a strong year of performance last financial year. And I think that's what you would see in some of the peers, even Indian peers with their international businesses reporting much better numbers relative to the domestic market.
Bala, I remember last time I spoke to you, you said you were available in 7,000 retail stores globally. Is that number moved a bit?
Manisha, yes, we are continuing to expand our distribution. At the same time, we're also going deeper within our distribution. So within the 7,000 stores I mentioned, we are also launching many new SKUs this year. And that's a strategy, we sort of have always taken to sort of double down on wherever we are at. But it's been a fantastic year for us. We saw strong double-digit growth in terms of our business. In net revenue, we also got back to EBITDA and PAT profitability last financial year. And I think, we hope to continue that growth streak this financial year as well.
Bala, what do those SKUs look like right now? And I know we keep talking about teas and wellness, but you are into spices as well.
Yes, we do wellness spices and powders, which is very interestingly, is actually a core part of our tea portfolio as well. Like I mentioned, the new age tea consumer is looking for, more than just tea leaves. They're looking for herbs, botanicals, and superfoods like turmeric, moringa, ashwagandha, herbs like chamomile, lavender, so many other ingredients, right? And that really what makes for a lot of what we do, even in terms of percentage of revenue. So when we got an opportunity and a lot of strong consumer insights from consumers who told us that they also want to consume these ingredients in different formats as powders, we of course listened to them and launched it. And I think we have seen very, very strong feedback and performance for some of those SKUs in the market as well.
So while you've expanded a lot internationally, what are the domestic plans now? Are you putting focus back here now?
So Manisha, I think, to be honest, our focus will always stay outside, just by the sheer size of our business there. But that said, I think we are now formally launching in the India market later this year. I mean, we are, of course, available and we have been selling in the market for the last few years, but we've actually never focused on the market in terms of launching products specifically for the India market. It's generally been products which have been selling in global markets, and some of those hero SKUs we've sort of launched in India. But over the next quarter, in fact, by August, we are planning to launch a range of some very specific products for the India market, given we believe, I think it's the right time for us to do that.
What is India specific according to you? I mean, TST, right? India, the only difference, Bala, is that you have masala chai, but global versus India, I'm just curious to know, what is India specific?
So I think that's a great question, Mangalam. So honestly, when I say, the India tea market, I think we divide it into two parts. One, of course, is your typical masala chai, which is actually a lot of it is, brewed with milk and sugar as we all consume it. That's one part of the market. And the other part of the market which is being driven by wellness, which is the green tea market, which is the herbal wellness tea market, which is primarily teas and infusions which solve for a certain problem, right? And that's really where Vadam plays at, even globally. And I think we have seen a very, very strong movement in that part of the market, even in India. And that's really what makes us believe that it's the right time for us to go specific. And when I say specific in India, while of course the core positioning stays the same, the fact that we source all our ingredients fresh from over 25 states in India, get it to our own facility, end-to-end manufacturing owned by us. So the quality, freshness standards stay the same. But there are, of course, differences in tastes, when it comes to the India market. For example, the kind of flavors India likes, right? So honey, lemon, mint, tulsi, these are some ingredients which are very native to India. And, it's very important as a brand, we make that available while keeping our core portfolio as the hero. So that's really what I mean by customizing some of our products, and we should be ready for our launch by August.
Bala, as of now, you're 97 international, 3% India. Is that going to change anytime soon?
I think, Manisha, I really hope it does. Because, being in India, I think, we would love for our India share to go up. And I see that happening as well. But that said, our global markets continue to grow strongly. And I think we see strong double-digit growth there with profitability over the next 3 years as well.
Is tariff impacting you in any sense?
It has. It definitely has. I think, there is still a 10% tariff, on all imports, which was not present, till 2 months back. So of course that has a certain hit on our P&L, not to the exact amount, because we obviously sell it to our US entity and then we distribute it. But it has a P&L impact. But I mean, given we are a brand, we believe we should be able to sort of accommodate that, without impacting our margins over the next few months. While saying that, I also strongly believe that, the India government should be able to negotiate a deal where, we should be able to get some protection as a category, because, there is honestly no conflict. America does not grow any of these products, right? So there is no reciprocal tariff, which will anyways come in. So I think we strongly believe, this 10% can also go back to where it was 3 months back.
Bala, I remember having initial conversations with you, and you totally believed in D2C, more digital in that sense. The latest reports do suggest that Assam, for one, when it comes to their auctions, is going to be blockchain, AI-backed, and etc. How have you seen that as a development?
No, I think it's very positive to see. I think the tea industry has been very, very traditional, Manisha. And I think, like all industries, using technology right from, blockchain to AI now, I think it's critical for it to continue to become more efficient, make it more convenient for buyers across the world to transact from. So I think it's all very positive to see, for us as well.
So you know what, Mangalam, my latest try has been saffron tea.
Yeah, saffron. You have been trying all things saffron right now, Manisha. It just reeks of the prosperity maybe that you have, and may that continue. But I just, the first 3 months of this season are out. What is your outlook on pricing? Because last year, a lot of the companies that I track were pummeled on the margins because of the tea prices. They said that they may see some normalization, but they'll have visibility only, once the summer sets in. So far, what has your sense been?
No, Mangalam, I think it's still too early. I think you're right. We hope that it will normalize. Like I said, for us, it does not impact too much, but a lot of the players were doing these more lower margin, like more commoditized products, which is the CTC tea, which is a big chunk of the market. I think they do get impacted by such single-digit increments as well. But I think so far, so good. But again, I think the summer season is just kicking in. It's June, so it's just kicking in Assam, I think even Darjeeling, some of the southern regions. So I think the next 45 to 60 days will be critical in how the entire year looks in terms of pricing.
Got that. We take that point. Thank you so much for joining in. Bala, we wanted to know about this for the CTC players itself, which are listed. You don't seem to be listing anytime soon, though we keep asking you that question every time. But we'll save that conversation for another time. Thank you so much for joining in. And thank you, Manisha, for taking us through that conversation. With that, we'll wrap up on this edition of Halftime Report. Business Lunch will take all the market action ahead.